Hi everyone, welcome to Buffett and Beyond Research Stock of the Week, and we're going over Google. And today is March 22nd, 2025. And remember folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's go over Google. Now, Alphabet is the successor and parent holding company of Google Inc., which operates the world's leading internet search engine, as if you didn't know that. Now, the company derives the revenues primarily through delivering targeted advertising, and revenues are also derived from the licensing of search technology and solutions to enterprises. Now, returns in the United States, 48% of its total, and international, naturally, 52%. Has about 190,000 employees. So it owns YouTube, Google Search, Google Cloud, AI, and just recently developed a quantum chip called Willow. Now, let me read a little bit to you about Willow. It was developed by Google, and the chip received a flurry of attention for its potentially revolutionary qualities and helped launch the stock to an all-time intraday high price of $202 on December 17th, and then it went a little bit higher on January of this year, 2025. And although Willow may drastically reduce computation times and may lead to breakthroughs in drug discovery, where'd that come from, through its reduced error tendencies, it might not widely be available for commercial use until 2030. So that's another 5-6 years from now. And the application delay is partly due to Willow's required operating conditions, including extremely low temperatures. Long term, this innovation could provide Alphabet with a strong competitive advantage. So that's the new deal with Google. So these companies that have been out there for a while, that are the big ones or part of the Mag 7 group, are developing new things as we go along, and that's what we want to see. Now, let's go over Google. Google is in green, and we're going to go over the numbers, and the statistics will tell us if this is a better than average stock, because what do we want in our portfolios? Yeah, we want the above average stocks in our portfolios and not the below average stocks. This is how you outperform the S&P 500. Only 4% of the professional money managers out there can outperform the S&P 500 over any 10-year rolling period. And folks, it's not always the same 4%, so we can't go looking for those guys and gals because they disappear after a while. So we want to make sure that Google is an above average stock before we even start talking about it. So the average stock is in blue, Google is in green, and we're looking at the clean surplus return on equity. Remember, the clean surplus return on equity is totally different than the traditional accounting return on equity, and it's used to be comparable between stocks and even between stocks in different industries. That's what's so beautiful about it. The traditional accounting return on equity is developed within the company and compares the company over time to itself. But the clean surplus return on equity compares one company to another company. Big difference, like 100% difference whenever you look at some of these clean surplus ROEs relative to the traditional accounting ROEs. So clean surplus ROE 24% versus the average stock 13.5%. Google's almost twice as much as the average stock out there. And how you look at this, where do you want to put your money? In a bank that's paying you 13.5% or a bank that's paying you 24%? Yeah. That's the difference. Now, net income, which is the clean surplus earnings, so the earnings are comparable to every other company. Average stock 13%, Google 19%. And when it comes to revenue, so you got to have the revenue coming in order to bring money to the bottom line. The average stock is 7.1%, and Google almost 3 times that at 19.7%. So we can see all in all that Google is or has better statistics than the average stock out there. So it should be outperforming the S&P 500. But let's look at the numbers a little bit closer, and let's look at the net income. Now, this is the clean surplus earnings for 2024 and 2025. Now, the reason this is in yellow is because in 2024, this number of $8.05 per share was raised from just a month ago, $7.65. So this was raised up nicely for 2024. Now, projected for 2025, it had been projected to be $8.65. Now it's projected to be $9. So you can see the earnings or the net income going up nicely. Now, it just started paying dividends, son of a gun, right? It had been zero all the way down here, and now they just started paying dividends. And we look at the clean surplus return on equity. Now, the average stock, remember, is about 13.5%. And to get into our growth portfolio, we want to see 20% or better. Yeah, and this stock has averaged 20% or better. And we can see that over the past 3 years, the average 22.48%, and over 5 years, 23.97%. Retention rate, well, we'd like to see a growth company put all the money that it's making back into itself in order to grow. Well, we have Google, even though it's a huge company, putting an average of 96% a year of its money back into itself in order to grow, and the rest it pays out in dividends, so it's paying 0.4% in dividend, which is good. We want to see a low dividend when you're talking about a growth portfolio. So those of you folks out there who are looking at dividends for growth, don't do that. You want to see a real growth company putting the money back into itself in order to grow. Now, if you have a portfolio where you need a certain amount of money coming out, then you could start looking for dividends. But the higher the dividends, the less growth you're going to see. But you still want to see the clean surplus ROE high. So that's what you look for. Now, years to pay debt. This is Buffett's rule of thumb, and he says if a company takes all the money it's making and puts it back into itself in order to grow, how many years will it take to pay off its debt? We're looking at 0.1 years to pay off debt. So we're looking, if it took the money that it makes in just a little bit over a month, it could pay off all its debt. So we don't have to worry about when interest rates going up that this company won't be able to function or grow. Yeah, it will. Now, when we look at 1 year, the black line is the S&P 500. This yellowish line, mustard-colored line, is Google. And we can see Google is just slightly outperforming the S&P 500. And just a couple of months ago, it was here at its high. And, folks, we want to see if that high was justified. And we're going to be able to tell in just a moment. But first, okay, Google is slightly outperforming the S&P 500, and of course we are in this nasty downturn in the market as I'm recording this, and the market is just starting to maybe find a base in here. That would be nice. So we'll see what happens, folks, over the coming weeks here. And let's look at 5 years. Yeah, and Google is up over 200%, while the market itself, as judged by the S&P 500, a touch under 150%. So we can see that over time, yeah, the statistics bear out that this stock is a good performing stock, better than the average stock, and that's what we want in our portfolio. Now, let us look at just Google. So this is Google. We are looking at 2024 here. This year's 2023, 2022. Yeah, the market was down that year, and so was Google. 2021 and 2020. So we want to look at the price at the beginning of 2020, which is really the end of 2019, isn't it? So we want to look at this price. Well, it was 60, but how much was it earning at the end of 2019? Let's go back and see. The end of 2019, it was making $2.58. Now, for 2025, they expected to make $9. Now, if we figure this out, this number, or I should say this number up here, $9, is 3.5 times that of what it made at the end of 2019, which of course is the beginning of 2020. So 3.5 times, it is expected to make 3.5 times what it made at the end of 2019. So if it was making $60 at the end of 2019, 3.5 times that gives you $210. So we are looking at this old high in here intraday of almost $210, and we can say, yeah, if things were normal, this price is certainly justified, at least by the end of 2025, this year and here. So we can say, yes, the price is justified. Right now, we're in a selling mode with the whole market in a selling mode. So if you take a 50-point difference between 210 and 160, that's 50 points. Well, 50 points divided by 160 gives you a 31% move that we expect by the end of the year, at least a 31% move back up to the recent highs that this stock had. And if it keeps growing and those numbers keep going up or adjusted upward, then this stock could be up more than the $210 that it was at just a couple of weeks ago. So that's a 31% move that we feel, if this stock is bought in here and the markets come back to normal, which we are pretty sure they will once this tariff situation is settled down and everybody gets settled down and the market says, gee, or the market participants say, gee, a lot of these stocks are oversold because of the earnings that they are expected to make, and we expect that 31% move from 160 at least back up to the recent highs by the end of the year. So we keep getting the question, are stocks oversold at this particular time? Well, Google certainly is, and many of the stocks that are in our portfolio are now oversold, and we think we're going to get a nice rise coming out of this decline in the market by and through the rest of 2025. So, folks, we had a bad, nasty 3.5 weeks or so in here between the market going down and our favorite stocks going down. But guess what? We're going to come back. We're going to come back strong because everything that's happening out there in the future is growth orientated. So remember, you go out this weekend, you have a nice weekend, forget about the market. And folks, if you want to walk on this very beach right here that Warren Buffett once did, you've got to learn how to invest even better than Warren Buffett. So folks, go out, stay safe, be with your family. We'll see you right back here in a couple of days.